Right now, the scale of the physical infrastructure required to train and run artificial intelligence models is demanding massive amounts of immediate capital expenditure. But the capital required to build this infrastructure is colliding with a strained macro environment. In the first week of August 2026, three highly contradictory market signals flashed at exactly the same time. First, the spread between the 10-year and 2-year Treasury yield curve began rapidly uninverting. Historically, this precise movement signals a macroeconomic transition out of a stable rate environment. Second, equity markets began aggressively separating technology megacaps. Investors stopped buying the broader sector and started punishing companies that couldn't prove immediate returns on their AI capital expenditures. Third, the U.S. Treasury stepped in to execute structural interventions in the foreign exchange market, attempting to counter sudden currency destabilization. The synchronization of these signals suggests the era of training on simple rate expectations has ended. Markets are now actively pricing in a more volatile, structural regime shift. This chart plots the spread between the 10-year and 2-year Treasury constant maturity yields. After a prolonged period of inversion, the curve has uninverted, reaching exactly positive 0.47% in August 2026. This steepening occurs alongside a deep division within the Federal Reserve. A recent 9-3 FOMC vote opted to hold the target rate at 3.50 to 3.75%, with 3 regional bank presidents dissenting in favor of an increase to fight inflation. We can measure exactly how unanchored market inflation expectations have become by looking at the 5-year forward inflation swap rate. It is trending sharply upward, breaking away from the static FOMC target. Federal Reserve Chair Kevin Warsh has maintained tough rhetoric on inflation. But institutional investors are looking at the static policy rate, comparing it to the inflation swaps, and concluding that the rhetoric lacks credible policy backing. By refusing to adjust the target rate to match these expectations, the Fed is effectively outsourcing the difficult job of tightening financial conditions directly to the bond market. This dynamic creates a specific systemic risk. If underlying price pressures reaccelerate, the central bank is already positioned too far behind the curve to respond effectively. Consequently, the U.S. dollar's relative real yield advantage, the premium investors receive for holding U.S. debt over foreign debt, is rapidly eroding on the global stage. Because the central bank refuses to act domestically, the sovereign bond market is independently tightening conditions, and the resulting pressure is fracturing global currency stability. To stop the bleeding and defend that eroding yield advantage, the U.S. Treasury Department was forced to take emergency action. They executed a coordinated intervention, buying an estimated $5 to $10 billion alongside Japanese monetary authorities to stabilize the yen and protect the dollar's relative positioning. For institutional capital, the operational directive during a coordinated intervention is simple. You lean with the official flow, not against it. This timeline plots joint FX interventions. In June 1998, U.S.-Japan action established a hard floor against yen weakness. In September 2000, the U.S., ECB, Japan, Canada, and UK coordinated a massive purchase to floor the euro. In March 2011, coordinated capital flows capped the currency pair. When sovereign entities step in together, they succeed. But the necessity of this August 2026 intervention highlights a weakness. It is a structural patch, required only because the Federal Reserve's domestic policy failure forced their hand. Underneath the abstract currency flows, verifiable corporate cash flow is still built on the relentless physical movement of goods and services. The macro environment of capital scarcity we see in the currency and bond markets has instantly translated into a micro-reckoning for equity valuations. Amidst this economic strain, Amazon's market value topped $3 trillion. The market rewarded them because their cloud and e-commerce infrastructure generated immediate, tangible profits. This comparative bar chart tracks the CAPEX to free cash flow ratio, showing capital no longer subsidizes promises. Investors demand immediate returns for AI cloud infrastructure. Consequently, Alphabet and Meta face severe market drawdowns. Their massive, long-duration spending plans hit free cash flow immediately, guaranteeing no short-term return. Equity markets mirror the bond market. Investors are heavily penalizing duration. Capital flees speculative infrastructure, seeking shelter in immediate cash flow. This exact same flight to quality is simultaneously fracturing the credit markets. This divergence chart from the TREP Senior Loan Officer Survey maps commercial real estate lending standards. It reveals a sharp bifurcation. Large banks are easing their standards, while regional banks are strictly tightening theirs. Large diversified banks possess the balance sheet capacity to absorb risk, but regional banks cannot afford that luxury. These regional banks are pulling back because they see direct evidence of labor market softening. In June, payroll growth slowed to just 57,000 jobs, signaling a drop in real economic activity. That slowdown is paired with a sticky 4.2% unemployment rate. For commercial real estate borrowers facing a growing refinancing pipeline, lower tenancy and less cash flow make securing new debt significantly harder. The regional bank credit squeeze confirms the real economy is buckling under the exact same cost of capital pressures that forced the Treasury's hand in foreign exchange. This dashboard maps the closed causal loop connecting all four economic sectors we've examined: rates, foreign exchange, equities, and labor. The first step is domestic. A softening labor market collides with unanchored inflation swaps, creating total paralysis at the Federal Reserve. That Fed paralysis breaks the currency markets, forcing sovereign intervention just to maintain baseline stability. Those broken currency and rate markets then force a ruthless corporate environment. Capital allocation across businesses and banks becomes strictly based on immediate survival, not future growth. This establishes the strict rule of this new economic regime. Duration is penalized across every single asset class. To survive a stagflationary transition defined by a central bank credibility gap, portfolios have to completely abandon their reliance on future rate cuts. The only shelter is in assets that generate immediate, verifiable yield and free cash flow today.